Good afternoon, and welcome to this ICMA webinar. My name is Mushtaq Kapasi, Head of Asia Pacific for ICMA. The purpose of this webinar is to update ICMA members and stakeholders in the region on key global fintech developments in the debt capital markets and the potential implications for Asia Pacific. Our presentation will outline ICMA's current engagement on fintech and the evolving landscape in primary, secondary, repo and collateral markets. We'll also explore DLT-related regulatory guidance, building on ICMA's research work on fintech and electronification. I'm very happy to be joined today by my colleague, ICMA's Gabrielle Carlson, who is a director in our market practice and regulatory policy team. Gabrielle is based in London and manages our global efforts on fintech. So without further ado, I'd like to hand over to Gabrielle to lead the presentation. Gabrielle, thank you.
Well, thank you, Mushtaq. Welcome also from my side. I'm delighted that you have joined us for this webinar today. We have a full agenda. By way of introduction, I will say a few words about ICMA's engagement on fintech and market electronification, followed by technology trends in primary, secondary, repo and collateral markets based on ICMA's mapping directories and research. Then our ongoing work on digital standards in repo markets linked to the ISDA common domain model, followed by developments around distributed ledger technology in bond markets and measures put in place by regulators to address fintech and innovation and relevant use cases for capital markets. But importantly, as Mushtaq already mentioned, there will be a Q&A session at the end. So fintech and market electronification are two themes that cut across all of our 600 members' activities, whether in primary markets, secondary markets, repo and collateral markets, and increasingly also in sustainable finance. Overall guidance on this topic is provided by ICMA's FinTech Advisory Committee, which was set up at the beginning of this year and taps into the broad expertise of our membership. It builds on the previous ICMA board subgroup on technology. This committee brings together front office, middle and back office, legal and technology expertise, and represents corporate issuers, public sector issuers, investors, banks, market infrastructures, and law firms. In its first two meetings, the committee focused on SDP across the securities lifecycle, common standards for data and lifecycle events, messaging protocols, as well as standardization initiatives within each of ICMA's pillars. Generally, our engagement reflects the uptake of technology. In primary markets, it is a point on the agenda of the various committees, rather than a sole focus. In secondary markets, a dedicated group, the Electronic Trading Council, ETC, brings together buy-side, sell-side, and trading venues to establish consensus views and create best practice, for example, for electronic X dissemination. In repo and collateral markets, we have a dedicated working group on the common domain model for repos and bonds, but I'll come to that later. We are also engaged in international working groups. ICMA is a member of the European Central Bank's FinTech Task Force and the IOSCO DLT workstream, which forms part of the IOSCO FinTech network. But of course, we also maintain bilateral relationships with many regulators. So if we take a step back and look at the factors behind electronification in cross-border capital markets, there are four key drivers. The first is efficiency and straight-through processing, which is reflected by the uptake of technology. Second is liquidity sourcing, which is specific to secondary and repo markets. The third being regulatory compliance, which as a driver varies significantly between each area. And the fourth is data management, which is of ever-increasing importance. I will come back to the examples in this table when we look at the technology trends. So in primary bond markets, the uptake of technology has traditionally been lower than in secondary or repo and collateral markets. That said, technology is playing an increasingly important role in the issuance process of debt securities to achieve SDP. And in contrast, regulation seems to be less of a driver, specifically within primary markets. This is also reflected in the primary markets technology mapping directory, where the number of applications has increased by 50% between December 2018, when it was first launched, and September last, when we published our second edition.
Gabriel, I would just mention, this is Mushtaq, that the ICMA Primary Markets Technology Mapping Directory is available for public on our website, as well as the other directories that will be
Yes.
mentioned in this presentation. So several of the technologies that are listed in the directory are global in nature. So quite a few of them are also active in the region. Actually, there are a couple of them that are originated in the region that are either global in scope, but sort of managed out of Asia Pacific, or more regional in nature. And for these directories, we really rely on market knowledge and submissions from people in the market, either the companies themselves, the solutions themselves, or the users of those. So we certainly encourage all of you on the call to go to our website. We'll provide the links to take a look at the technology directories. They're quite detailed in terms of their functionality and scope. And feel free to send us suggestions for additions to these mappings.
Yes, absolutely, Mushtaq. That's right. And we would, of course, appreciate any feedback on the directory. We try to be as complete as possible, but it is, I think, non-exhaustive also, given the pace of change in primary markets. But just to add to this, the directory institutional investors and others, whether it's for securities issued via syndication, auction, or private placements, covering different types of debt instruments, from IG bonds, high yield, but also other more regional products such as Schuldscheine and loans. It's quite a broad spectrum. And just to give you a few examples, some solutions aim to gauge interest from investors, improve and streamline communication channels, capture relevant feedback from roadshows, view deal terms, build order books, or automate allocation rules, and automate the creation of legal documentation. And I think what's important to highlight is that the focus is generally on process electronification, not disintermediation. So making existing processes work better, providing better connectivity between the various parties involved in a deal. There are also interesting machine learning applications, but it appears to be in early stages still, at least in DCM. For example, to predict investor demand for syndicated bond issuance, where one of the obstacles is the availability of data and data quality. There has also been increasing interest in DLT, which we will discuss in the section on DLT and bond markets. But as Mushtaq, as you mentioned, we have observed that there are solutions that are global in nature, but many are still, let's say, more local and have a specific or local target market. They are adopted on a broader scale. There's, for example, book building as an exception. But it's interesting to see how some solutions are target a specific market and then expand, whether it's from Europe to Asia or the other way around. Now, secondary markets are much more advanced in terms of electronification. Sourcing liquidity is a key driver. There is a well-established ecosystem of electronic trading platforms, information networks, and order management systems. Our ETP mapping directory lists a total of 43 execution and non-execution venues. And interestingly, we have observed a relative saturation. It is a difficult environment for new entrant platforms. Electronic trading is widespread, notably for more liquid instruments and smaller sizes, but it continues to rise with a trend towards automation. Regulation is clearly a key driver in Europe, reporting obligations to regulators, but also public reporting requirements under MiFID II and MiFIR.
And I can add for Asia as well, I would echo the point that Gabriel just made about regulatory requirements driving a lot of the electronification of secondary markets. So I have to admit, when I was new to this, I basically thought of electronic trading platforms as trading venues, places where you execute trades. But increasingly, a lot of the technologies that are being used in secondary markets are being used largely for the compliance, the data capture aspects, and the organizational aspects, not just to increase liquidity and put together buyers and sellers. So in this directory, we see not only trade execution platforms where you can actually trade, but also informational systems where you can find pricing and capture trade values for auditing purposes.
That's absolutely right. And to add to this, there are two charts here from our third study on the state of the European investment grade corporate bond secondary market, which we published in March this year. And These two graphs here depict really the trend towards further automation of buy-side workflow in terms of automated execution and OMS usage on the one hand, and sell-side auto-quoting technology on the other. There is more in-depth analysis in the report, for example, on direct connectivity and other trends, which I only recommend reading. Also more detail around evolving protocols, whether it's new trading protocols or other developments in electronification.
And I may just add, sorry, quickly, Gabriel, I may just add to
Sure.
the previous slide, slide 6, that while the graphs that you see there are focused on the European markets, we have just published the third study on the state of the European investment grade corporate bond secondary market. We also have a study that we published about a year and a half ago on the Asia Pacific corporate bond secondary market, where we asked similar questions about the electronification of the markets. The general conclusion is that the markets in Asia are a little bit less down the road, so to speak, in terms of electronification. There are a couple of reasons for that. One is, I think, cultural, and another is the relative size of some of the domestic markets, which have fewer players and probably less requirement for these sorts of broad market technologies. But we have definitely seen a trend of further electronification of the secondary markets in Asia, particularly for small sizes, for discovery purposes, and for regulatory and compliance reasons, as I just mentioned. We are refreshing this survey, so to speak, and we expect a second paper on the Asia Pacific bond market to be coming out later this year, which will be updating some of the conclusions that we made about electronification of the markets for more of an Asia Pacific angle.
Yes, that's right. That's expected. Yes, I think in the coming months, in the Q2 or Q3.
Yeah, and certainly, if I may just plug, if anyone on the webinar would like to participate in in the research for that, the research behind these papers is a combination of quantitative data from various market sources, combined with surveys, as you see here, and also combined with qualitative interviews. So we're very interested to speak to people in the market, either who are creators of these technologies or users of the technologies, to hear your views on trends and uptake.
Absolutely. But moving into repo and collateral markets, as you may be aware, we have recently published our repo trading technology directory, which includes 12 electronic platforms, including Chinese and Japanese venues. And this equally is a market segment which is rapidly evolving. And the directory aims to help members understand what types of venues are available, whether it's dealer to dealer or dealer to client, for instance, the product scope, as well as differences in trading protocols, clearing, and collateral configurations. But it's important to highlight as well that on the back end, there is a myriad of technology systems for collateral management and related areas, whether it's liquidity monitoring, corporate actions, etc., which are referenced in the Fintech mapping directory for repo and cashment operations. And this was developed now over 2 years ago by the Fintech Working Group of the European Repo and Collateral Council, the ERCC, and it is kept up to date on a regular basis. What's interesting here is that efficiency is clearly an important consideration from an operations perspective, but regulation, again, is arguably a key driver for electronification of repo trading, with the advent of reporting obligations under the EU Securities Financing Transactions SFT regulation, which was due to enter into force this month, but has been postponed to July 2020, so July this year, due to COVID-19. And this is a good segue into one of our FinTech priorities, which is about digital standards in repo markets. For those on the line, we are now on slide 8. And the CDM is essentially a trade processing model, which outlines the operational steps in a derivatives transaction and translates them into code based on common definitions and representations of lifecycle events. Or in other words, it is a machine-readable and executable model. And the expected key benefits include, for example, enhanced interoperability and STP between market infrastructures, greater internal efficiencies for firms, various processes and IT applications, whether it's for quoting, trade execution, trade confirmation, reconciliations, settlement, risk management, and regulatory reporting. The third benefit is consistency of regulatory reporting between firms and better regulatory oversight. And fourthly, the CDM also provides a common foundation for developing innovative solutions, whether it is based on conventional technologies, but also whether for DLT, cloud, or others. And it's important to note that the CDM works as an interface to different existing standards, such as FIX, FPML, ISO 20022, and APIs. And
so Gabriel, I have to confess, my background is not in operations, and some of these terms like FIX, XML, APIs are rather foreign to me. But fortunately, I have had some experience directly with CDM in a recent hackathon in Singapore last year, where teams were tasked to find different solutions to actually apply CDM to real life trades and real life cycles. And my impression was that it's a very important and useful technology because, at least the way I look at it, and correct me if I'm being inaccurate about this, it's basically a common language for representing trades and trade events between different systems, between different proprietary systems within
yes,
different participants in the financial industry. So basically it allows, it's almost like a translator, like a common language for different internal booking systems to speak with each other, which is extremely important in order to prevent misunderstandings between banks, prevent operational fails, and also provide a common language for, as you mentioned, regulatory reporting. So
yes.
it's a very significant operational advance, and we're working very closely with ISDA on it and participants in the market, particularly on the repo product.
Yes, absolutely. And we have recently held 3 workshops with ISDA and Prognosis, the technology firm behind the CDM, to model features of repos, so open repos, repo interest payments, and a simple DVP scenario. So without going into every detail, in practical terms, this involved, first of all, describing the sequence of steps that reflect a lifecycle event, for example, of repo interest payment, incorporating these elements in the form of code in the CDM, and then running a real-time demo, showcasing the output that the CDM generates and how the data is validated based on embedded rules. But importantly, the workshops also enabled us to identify commonalities and gaps between derivatives and repos, as shown here in the table. For example, from the left to the right, the first column, the transfer of cash, which corresponds to payments in a derivatives contract, or DVP in a repo transaction, or the termination of an open repo, which is comparable to the exercise of a call option in a swap. But the processes and underlying logic are different. For example, the notice periods or exercise dates, which can be at a given point in time only for swaps. But there are other gaps. One of the most obvious is collateral substitution, which is specific to repo or references to the Global Master Repurchase Agreement, the GMRA. If you're interested to learn more about the CDM, you can find some of the workshop materials on our website. But if you would like to become actively involved in the CDM and contribute to the development of the CDM roadmap for repos and bonds, then please do get in touch. So now let's turn our focus to DLT and bond markets. So when we look back at the last 3 years, we have seen a continuous increase in DLT proofs of concept test transactions and announcements to test and implement DLT in capital markets. And nearly 2 years ago, we set up a dedicated web page on our website that tracks all of those DLT developments in bond markets, totaling over, I believe, 30 relevant initiatives globally. Now looking at Asia Pacific, there are a number of interesting developments, some of which we have listed here. There's the World Bank bond issuance in 2018, which is noteworthy because it was a live transaction, raising a substantial amount of over 100 million Aussie dollars. And since then, there has been a secondary transaction and reopening in 2019. But that said, the cash leg was executed off ledger, which highlights the limitations of achieving DVP using DLT in the absence of central bank digital currency. which is in fact true for most transactions. But this is something that the Monetary Authority of Singapore, Singapore Exchange, and others have explored within the phases of Project UBIN, which was launched in 2016, addressing in particular the questions around CBDC, so the central bank digital currency, but also interoperability between DLT networks across assets and the payments infrastructure. And according to the latest news, it appears that China is also in the process of testing some pilots related to its own CBDC. And it'll be interesting to see how this develops. And then in the last few months, we have seen further announcements to develop pilots or proofs of concept by Bursa Malaysia for securities lending. The Thai SEC launched a master blueprint to launch a DLT-based corporate bond pilot, announced in November last year, which was followed in March this year by an announcement by the Japan Exchange Group and Japan Securities Depository Center to create a post-trade information. It is, of course, difficult to comment in more detail on individual initiatives, which would require participation from some of the stakeholders who are involved. And this is beyond the scope of this webinar. But I'm going to make a few general observations when it comes to DLT and bond markets. I think generally there's no standard terminology, and often there's confusion around the concept of tokenization and dematerialization of securities. Most initiatives so far are purely proofs of concept or pilots. A missing key element is central bank digital currency. But a common point between many DLT initiatives is that, ironically, they create a centralized platform, centralizing certain functions, for example, of registrars or paying agents, exchanges, CCPs, or custodians. And one of the key characteristics of blockchain, which is to build trust between third parties in the absence of a trust intermediary, becomes entirely redundant. And this boils down then, in many cases, to the implementation of a next generation database, which has very little in common with blockchains used in a decentralized environment.
Gabriel, if you don't mind, I'll just interrupt with a quick question. Actually, two questions for you regarding DLT that I hear quite often in the market. First of all, can you explain a little bit more what exactly is meant by some of the technical terms that you mentioned, particularly tokenization and dematerialization, and how does that relate to bonds with DLT?
Sure. So I think tokenization is a term that has been used in the context of initial coin offerings, which were means to raise capital by startups who are in the early stages of raising capital. And tokenization in that context meant that investors receive a token or something, a digital form of contract in return for which they receive perhaps dividends at a later stage or certain access rights. In the capital markets context, we have seen different approaches, even though there is no, as I said, no kind of standard for it. Tokenization sometimes refers to traditional securities being immobilized and then represented or referenced through a digital token, which has the same rights attached. And in other cases, it is used to describe securities that are created entirely in a DLT environment, so digitally. And I think the point on dematerialization is that in many instances, securities or the underlying, let's say, IOU is already in digital form. And this is where the lines between what is a token and what is then actually security in dematerialized form becomes blurry. But I hope this answered your question, Mushtaq.
It did, thank you.
But just to add to this, there are also other considerations, in particular of legal and regulatory nature. And this is why we launched at the end of last year a directory which summarizes the regulatory and legislative developments in relation to DLT. And to accommodate the use of DLT, legislators, regulators, and international standard setting bodies have taken different steps, depending again on the specificities and legal system in their jurisdictions. And broadly speaking, the approaches can be broken down into the following categories. Some laws that have been adopted aim primarily at clarifying definitions of DLT and smart contracts. Then there's other initiatives, in particular international level, to address interoperability and standardized protocols. And this is something that ISO, for example, has addressed, or the United Nations International Communication Union. And then the third category is about security, resilience, and corporate governance, where regulators have articulated specific licensing or registration requirements or business principles. And this directory that we've launched covers a wide range of jurisdictions across the globe, covering also Asia in particular. I've pulled out a few examples here just to illustrate the different approaches taken. For example, in France, legislative changes were introduced to enable the use of DLT to record securities and transfer ownership. In Australia, ASIC provides guidance on evaluating DLT. In China, with specific regulations by a technical agency on the management of blockchain information services have been adopted, or at an international level, the adoption of a first DLT standard by ISO in September last year. Similar to our other resources, the directory is available on our website, and we would welcome, of course, any comments or additions, as this is a living document. Sometimes the challenge for us is to find official sources in English or that are easily accessible. But speaking about DLT and the measures implemented by regulators and legislators leads me now to the final section on the measures regulators have put in place to address fintech more broadly. And for those on the line, we are now going to slide 12. So globally, regulators have put in place different schemes to respond to the rise of innovation in financial markets, which can be broken down into three categories. The first being innovation hubs as points of contact, fintech accelerators for central banking use, and regulatory sandboxes. And I think generally over the last few years, there has been a global trend to create regulatory sandboxes. And the structures and functions vary between the jurisdictions, but usually it is a controlled environment where certain regulatory requirements can be loosened under supervision by the regulators. The UK FCA coined the term regulatory sandbox. Their sandbox became operational in May 2016. In Asia, Hong Kong and Singapore were the first to launch their respective regulatory sandboxes. And from an ICMA perspective, there are two key questions. The first is, are there any relevant developments for capital markets? And what are the potential implications? And I think it's important to highlight that it appears that most tests are outside capital markets, and they're more focused on retail or other sectors such as insurance. The FCA regulatory sandbox has seen over 140 solutions tested since its launch, and applications for the sixth phase were open at the end of last year. In Hong Kong, over 120 solutions have been tested, with the majority looking at RegTech, which makes up nearly 50%, while others focused on API services, biometric authentication, amongst others. And in Singapore, the initial focus appears to be on robo-advice, wealth management, and other applications, and then more recently, within the Sandbox Express on bond markets and retail access. On an international level, the Global Financial Innovation Network, or what the FCA described as a global regulatory sandbox, was launched at the beginning of 2019. As of now, it brings together 50 regulators and other organizations, and the purpose is to enable cross-border testing. The first phase of selecting firms was completed last year, but for now it appears to be on hold, as regulators found the firms were not ready to test. But the second question for ICMA is, what happens after the sandbox? Do companies successfully launch a product? And I think this remains an open question. There are very few we are aware of that have successfully transitioned from the sandbox into the market, but some are listed, in fact, in our primary markets technology mapping, even though they appear to be slightly outside the public markets. So for those who are interested, further details can be found in the report, which is referenced here. And this report was released in 2018, but we will also be publishing a follow-up report this year. And this brings me to the end of this presentation. Thank you for listening. I hope you find it useful. All of the resources mentioned in this presentation can be found on our website. If you have any questions at a later stage, you can contact us on the below details. But for now, I'd be very happy to take any questions.
Thank you very much, Gabriel. And we do have a couple of questions already from those on the line. First of all, regarding DLT again, what value or efficiencies has DLT delivered in practical terms so far for the capital markets?
I think it's a good question, and probably a bit difficult to answer, because many of the proofs of concept and pilots have been, let's say, standalone projects so far, even though there has been developments in particular in the Euro commercial paper market, where we have seen a very interesting evolution of DLT, which was initially used to create the security in a DLT network. Then commercial bank cash was tokenized to achieve DVP, to shorten settlement cycles and enhance and streamline the entire process. So I think the main benefit so far seems to be really process efficiency and process automation. But I think the key challenge here is that it requires ideally central bank digital currency on the one hand, but also it requires broad adoption to be able to achieve these benefits, because some benefits may be achieved in isolation. And I think interoperability is another key challenge to it, because what would be a negative of DLT is to have different platforms that are not interoperable, and where capital is where capital or liquidity pools are isolated or fragmented. So I think the jury is still out to really see what the benefits of DLT are. And I think it also goes back to the question, is it just a different type of database or next generation system? Or is it more DLT similar looking to blockchain in a decentralized environment? And I think there will be different applications. I believe that it's likely to be less disruptive, but just a natural evolution towards more efficiency.
And thank you. And I'm certainly no DLT expert myself, but I have spoken with, of course, a number of market participants and traditional bankers and lawyers about the recent applications of DLT. And I think there's a cautious optimism from what I can sense from Asia Pacific. But similar to what Gabriel said, I think that it's not necessarily seen as a revolutionary technology that's going to change the way deals done, but it is seen as having potential value in the way it can make deals more transparent or more efficient or less error prone or reduce operational risks. So it's actually quite similar to the successful technologies that we're seeing in the primary and the secondary markets. Most of the ones that have caught on are ones that basically take existing processes and just make them better and make them more efficient. And I think to the fact, if DLT can do that in certain ways, then it's quite valuable. Okay, we have a few more questions already, so I'll try to get through as many as we can. The next one, Gabriel, do you see the regulatory-driven corporate bond electronic system either one, hinders or promotes development of primary and secondary system? And do you also see it as being well received by the market participants, even with regulatory requirements, but potential benefits in the long run? So I'll try to reword this. I think basically the question is, how do you see the electronification of secondary markets in terms of it being regulatory driven? Is this something that is generally welcomed by market participants as having potential benefits in the long run, or does it tend to be more of a hindrance?
Yes, I think that's a very good question, in particular on primary and secondary. I think there's, of course, I think two sides. Implementing regulation, MiFID, for example, has been extremely onerous, and it's taken time to require build of new IT applications, etc. But I think there is a sense that it has driven electronification, which is seen as a benefit. Markets, it brings more efficiency. I think primary markets has been less impacted so far by regulation in the sense that it has pushed electronification. But I wouldn't say that regulation has hindered the development of primary and secondary market systems. I think it is indeed interesting to see that so far these two areas seem to be quite fragmented in the sense that there's very few firms covering the issuance and then the secondary market trading. But I think it'll be interesting to see how this evolves, because electronification now is quickly happening in primary markets. There are new entrants in the space that are specifically looking at primary. But if we look at secondary, it may make sense to use certain protocols, or for example, messaging protocols are used there in primary as well. So, but I don't think that regulation has had any negative impact on this.
Okay, thank you. Next question. This one's a little bit technical, so I apologize in advance for this. But with respect to DLT, one of the purported benefits is T+0 settlement. Is this possible, and is this actually feasible in the current markets?
Yes, I think that's a good question. It's often, I think, instant settlement of T+0 settlement is often portrayed as a key benefit of DLT, but I think this is not already, at least here in the Eurozone. If you look at the settlement system T2S of the European Central Bank, it is technically possible to settle on a T+0 basis, but it is not market practice. So I think there is a gap between what is technically possible already without DLT and what the market wants. And I think in some instances, for example, if you look at commercial papers, there may be demand for faster settlement cycles. When it comes to bond markets, I don't think that there is a great demand to settle, let's say, T+0 or T+30 minutes or 2 hours. And so I think it is not only a potential benefit of DLT. As it stands now, I don't see particular demand from the market to be able to settle T+0.
Yes, I would have to echo that. I think certainly from a theoretical point of view, T+0 settlement sounds like it has some major advantages, but I think for various reasons, the market is happy with a little bit of a lag there. And I think there are a couple of things going on here. One is that there are just certain aspects of the markets and certain practices that are very hard to change because there are, again, there are operational, there are legal reasons for them, there are compliance reasons for them. So it's not just the way people are used to doing business, although that can be part of it. And certainly we've seen in the past few weeks that people are very adaptable to doing business in different ways when it's so required. So I think that is sometimes a partial issue that leads to the non-adoption or slower than expected adoption of new technologies. But I think in my experience, sometimes the solutions providers tend to be a little bit more optimistic than they might need to be about how quickly new ways of doing things driven by technology can be adopted by the markets.
Yes, absolutely.
Okay, and I have one more question. I don't know how much you'll be able to answer this, Gabriel, but maybe just a brief answer based on your experience. Can you also comment on fintech applications in sustainable finance? So with things like green bonds, social bonds, ESG reporting.
Sure. I think it's an interesting area because this is where fintech can potentially play an important role. I think in terms of process of issuing, how it's traded, if it's repoed out then or not, this existing technology is equally applicable to the entire process here. But I think there are potential benefits in terms of traceability, understanding how the proceeds are used, to make sure that they're used as set out initially for green projects or social projects. But I think it is still early stages here. I think fintech can play a role also in understanding the landscape in terms of analytics, data, understanding how green companies are, what efforts they're undertaking. And I think you probably have an angle of big data here and machine learning and fintech, where you could see potential applications to understand, to have essentially greater insights. But I think this is very different from the existing process electronification angle. There are also some interesting examples around blockchain and creating greater transparency, in particular for impact reporting, which are interesting. But I think this area is still evolving and there are many potential avenues, even though it is not entirely clear yet which one is going to be, let's say, the most promising.
Thank you, Gabriel. And in my limited experience, I think I've had similar, I would have similar thoughts. Most of the applications that I've seen that have seemed to get some traction in this space, I guess you could call it green tech perhaps, are those focused on really the practical aspects of sustainable finance. One might say the most boring aspects of
Yes,
sustainable finance, things like automating reporting, automating portfolio analysis, for example, gathering and structuring data, these sorts of things. Really more of the nuts and bolts and operational aspects of maintaining a sustainable portfolio or being a sustainable investor or issuer.
Yes. I can see there's one other question here on the Japanese initiative. The question is the Japan initiative just for DCM? Is that also tracked on our website? So to answer in brief, this initiative is available on our website under the new fintech applications in bond markets. And it appears, according to the announcement by JPX, that it's for capital markets. So I imagine encompassing bonds, but also equities. But this is something to be verified, ideally with the with Japan Exchange, and I'm sure there will be further details on this, whether it's to what extent it covers also other asset classes.
Okay. Well, thank you very much, Gabriel, for that. And thank you all to the listeners on this webinar and the viewers. We really appreciate your time and your interest. If you have additional ideas for webinars or other topics that we should cover that would be helpful for you to know about, please do feel free to send your feedback directly to me, Mushtaq Kapasi, or to my colleague Wing Wong at icmagroup.org. We will be continuing to hold a number of webinars, podcasts, and also virtual events over the next few weeks and months until we're able to all meet in person. If you have further technical questions about this webinar or any other aspects of FinTech, you may also send them either to me or to Gabriel directly. And we do invite you to visit our website and the FinTech section, which has all of the directories that we mentioned, as well as a number of papers and other third-party resources about FinTech. Please stay healthy and safe. Thank you very much. Goodbye.